They all track the same 500 companies: Apple, Microsoft, Amazon, Tesla, Google. But here's the weird part. If you invested 10 grand in each of them 10 years ago, your results today wouldn't be the same. Same companies, same index, yet somehow different returns. Yes, I'm talking about SPY, VOO, and SPLG. Three ETFs that look identical on paper, but quietly perform very differently in real life. And here's the kicker. Choosing the wrong one could cost you thousands over time. So don't click away, because by the end of this video, you'll not only know which one gives you the best long-term return, but whether you should switch from the one you're currently holding. That's if you are just starting. All right, let's back up for a second. SPY, VOO, and SPLG are all ETFs that track the S&P 500, basically a list of America's 500 biggest companies. It's like buying a piece of the entire US economy, from Apple's iPhones to McDonald's fries. The S&P 500 is the gold standard for US investing. But here's the twist. These three ETFs don't perform exactly the same, even though they track the same index. And that's where things get interesting, because those small differences can turn into big gaps over time. Let's meet the contenders. SPY, the original gangster of ETFs. Launched in 1993 by State Street, it's literally the first ETF ever created. Expense ratio? 0.09%. Not bad, but not the cheapest either. Liquidity? Off the charts. Over $500 billion in assets and some of the highest daily trading volume in the world. Next up, VOO. I call the Vanguard's golden child. Launched in 2010, it came out swinging with a mission: same exposure, lower cost. Expense ratio? 0.03%. Practically free. Assets? Over $400 billion. Vanguard is known for putting investors first, literally because the company is owned by its funds. And then there's SPLG, the budget clone that people really underestimate. Originally launched in 2005, but restructured in 2020 to track the same S&P 500 as SPY. Expense ratio? An insane 0.02%, cheaper than your morning coffee. Assets? Around $30 billion, so smaller but not irrelevant. Let's talk about the boring stuff that actually matters: fees and liquidity. A 0.09% fee versus a 0.03% doesn't sound like much, right? But over 30 years, that difference on a $100,000 investment adds up to over $17,000. That's not pocket change. That's a brand new Tesla tire. Okay, maybe two. SPY costs more because it's older and structured differently. VOO and SPLG keep it lean and efficient. That's why long-term investors love them. But to be fair, SPY dominates in one category: liquidity. It trades like water, over 100 million shares daily. So if you're a trader who needs in and out fast, SPY is your go-to. Now let's talk about what everyone really cares about: returns. Over the last decade, here's how these three ETFs have performed on average. SPY, about 12.6% per year. VOO, about 12.8% per year. SPLG, roughly 12.7% per year. Those numbers look super close, right? But don't let that fool you. A small difference in returns combined with fees adds up big over time. Let's say you invested $10,000 on each of the ETFs over a period of 20 years. Here's what that money would look like today. With SPY, you'd have around $32,000 after paying about $3,000 in total fees. With VOO, you'd have roughly $33,000 with only $1,000 in fees. And with SPLG, your money grows to about $32,000 and you've paid just $600 in fees. So yeah, they all track the same index, but over the long haul, VOO quietly pulls ahead while SPY slowly bleeds value through higher fees. It's like a slow leak in your portfolio you don't even notice until it's too late. The point is, even a fraction of a percent matters when you give it time to compound. Also, a quick note on dividends. All three pay quarterly, but timing and reinvestment efficiency can differ slightly. Not huge, but worth knowing if you're reinvesting every penny. They are focused on stability. Okay, so which one's right for you? If you're a trader, SPY is your friend. High liquidity, tight spreads, instant execution. If you're a long-term investor, VOO is the move. Lowest fees, trusted Vanguard management, and ideal for retirement portfolios. And if you're just starting out or want to minimize costs even further, SPLG gives you the same exposure for less. Here's the FOMO part. If you're holding SPY long-term thinking it's fine, you might be quietly paying thousands more than you need to. You don't have to sell it tomorrow, but maybe it's time to compare your numbers and see if a switch to VOO or SPLG makes sense. Because every fraction of a percent matters, especially when compounding for 15 to 20 years. Okay, here's your real wealth hack for today. Stop chasing the best ETF. Start matching ETFs to your financial goals. SPY gives you speed. VOO gives you long-term efficiency. SPLG gives you cost advantage. Want a pro move? Split your portfolio. 80% in VOO for long-term growth, 20% in SPY or SPLG. That's how you get the best of both worlds, performance and liquidity. Because wealth isn't built on hype or timing the market, it's built on time in the market. And if you're still watching right now, congratulations, you're already ahead of 90% of people who talk about investing but never do it. So, which ETF are you going with? SPY, VOO, SPLG? Drop it in the comments. I actually read them. And if this video helped clear the confusion, smash that like button, hit subscribe, and share it with someone who still thinks all ETFs are the same. This is Real Wealth Hack, and I'll see you in the next one, where we don't chase hype, we build wealth smart.